Good morning, everybody. I'm Andy Bates, Innovation Manager and Intellectual Property Lead here at Business West. And a very warm welcome to all of you and to our autumn webinar and thought leadership series, Innovate 2021, Overcoming Challenges and Building for Growth, supported by Business West and Innovate UK. This series of webinars is running every Tuesday throughout the autumn, covering topics from design thinking to funding and finance, leadership strategy, and sales and marketing, as well as promoting the wider bespoke support available from us and how we can add value to your future plans in what is a very challenging business environment. Kicking off the programme is a four-part series on intellectual property being delivered in partnership with our colleagues at Ingot. And I'm delighted to once again introduce Martin Brassel, CEO of Ingot, who'll be our host for this fourth session titled IP Valuation for Exit, Reaching the Right Price for Your Intangible Assets. As a participant of Innovate 2021, and I have to say subject to Innovate UK eligibility criteria, there is the opportunity to access our comprehensive range of IP support, which does include advice from our in-house patent and trademark attorneys, access free of charge to our online IP valuation tools, which typically cost £600, and in some cases, access to a £2,500 subsidy towards the cost of an intellectual property audit from an external IP attorney. And again, that is all subject to meeting Innovate UK and Intellectual Property Office eligibility criteria. I can discuss next steps and how to access these services at the end of the session. But before I hand over to Martin, I'd just like to go over a little bit of housekeeping with you first. Just to say to start with that for on-demand purposes, this webinar is being recorded and your personal video and microphones will not be used unless you're invited to speak by the host. Having said that, we have got a Q&A session and we have got a Q&A function as part of Zoom. If you have any questions, please enter those into the Q&A section, which is being moderated. Again, if you've got any problems, please raise your hand and one of the team will assist you. And also there is the chat function as well, where you can communicate with others that are on this webinar. That is unmoderated. So again, if you do have any questions, then please do use the Q&A function and not the chat. Also, we will be providing slides after the webinar, and you'll get a chance to have a copy of those. Now, without further ado, I'd like to hand you over to Martin, who is going to begin this session for us. Over to you, Martin.
Thank you very much, Andy, and good morning, everybody. I'll just get my slides up on screen. I'll just look for a thumbs up to make sure that you can see those okay from Andy. There we go. Well, good morning, everybody. Gosh, time flies. This is the fourth in the series that we've been doing on intellectual property, and particularly focusing on this whole area of value creation and value identification. And I suppose today is much more about value realization. How do you actually work out how you get, if you like, the prize that's been awaiting you all of this time for all of the investment that you've built up in intellectual property and other intangible assets in terms of selling your business. It might seem like a slightly odd time to be talking about business sales, but actually just yesterday, I received a letter out of the blue. Well, I must be on their mailing list from these chaps. I don't know if you can see that on the web camera. KBS are one of a number of companies that tout their wares in terms of helping business owners to sell their businesses. And they did make a couple of interesting points. I mean, apart from the fact that we know acquisition activity hasn't stopped during this pandemic, they pointed out the fact that at the moment, capital gains tax regimes are actually reasonably generous. I was probably, like many of you, not particularly happy at the fact that the Chancellor decided to pull quite a lot of the entrepreneurs' relief benefits. So, you know, it was up to £10 million. I think recently you only paid 10% tax rate, and now that's been limited to 1 million. But even then, the capital gains tax at the moment on business assets is 20%. Now, there have been rumours that in order to pay for all of the support that's been given during the pandemic, that could go up very substantially, thereby reducing the amount that you can actually realise from the sale of your business. The rumours were anything up to about 45%. Let's hope you won't go there. But in any event, it's not necessarily such a bad time, although of course due diligence is going to be an awful lot more problematic when people can't move around so freely and have the kind of face-to-face meetings, you know, formal and informal ones that you would normally have. So if there is interest in acquiring a business, whether you're the buyer or the seller, actually you're going to have to do things in a slightly different way. And so this focus on how you put forward the best case is going to have to be very much more information and data driven probably than it is relationship driven as it may have been in the past. So just with that thought in mind, let me talk about today's topics. Intellectual property runs quite a big risk of being left out in the way that people used to think about how they valued their business. And I want to talk a bit about that today and show you how you can address that shortcoming. There are a number of IP-rich exits I'll briefly touch on that should hope to show you why it is that this IP value is real and is making a significant difference to exit valuations. I'll briefly touch on why it is that corporates won't just buy your IP, even if you wanted to sell it, which is probably the main reason. And then focus a little bit on what types of IP that you might have are likely to drive value and what actual valuation approaches might be used in this kind of exit scenario. And then I'll finish off just with a couple of words on the special offer that's available to people through the Enterprise Europe network to be able to take advantage of our IP valuation tools. But I'm going to start with apologies in advance to any accountants present on the call. I normally ask for a show of hands at this point, but I won't today. With a little bit of accounting insight into why IP risks being what I would call an invisible asset. And that's a risk that I think you really need to address quite carefully. So, the difficulty that we have with intellectual property is that the accounting rules say that cost, either of purchase or acquisition or of development, is the only way that you're allowed to bring any kind of intangible assets, like IP rights, onto your balance sheet. And there are two methods specifically. One is called development cost capitalization. And what that enables you to do is to spread the investment that you've made in some intangibles over the expected period of business benefit. But there are a lot of restrictions and limitations to this. So for example, brand building activity is specifically excluded. The kind of thing that companies generally tend to be able to capitalize is, for example, software development. But you can't capitalize any research, which of course where some of the risks and returns are highest. It has to be development because it has to be towards an expectation of a financial return that you can reliably quantify. That's the test that your accountants will have to apply. Now that set of rules is different from acquisition accounting rules. So after a business has been bought, an acquirer has to decide what it paid for three categories of asset. One is tangible assets like property and machinery. One is identifiable intangible assets. So these are things that are separable, legally identifiable things. And everything else gets put into a bucket called goodwill, which in that specific context means just one thing, which is the price premium that you've paid over and above whatever the asset value is deemed to be in order to acquire control of the business. And those two sets of rules are really quite different, and they raise a number of challenges. Two of the obvious ones are, when you capitalize intangibles, you have to write them down or amortize their value over a period of time. So the value of your intangibles will seem to be going down when, of course, if you're running the business well and everything is progressing as planned, it'll actually be going up. And then the other issue is that if your business were to be sold or you buy somebody else's business, intangible value sort of appears as if by magic after that transaction happens, because the rules governing accounting for development and accounting for acquisitions are different. This used to be a problem that only affected large companies like corporates, but since the accounting rules were changed a few years ago into a new set of regulations which have the catchy title of FRS 102, actually pretty much all acquisitions have to go through this more stringent accounting practice. Now, this raises a couple of specific challenges in exit, at the risk of bringing back bad memories, I'm reminded of the phrase double whammy. The issue is that your balance sheet as a business that you may wish to be acquired has a tendency to look weak when you're an IP-rich business anyway, because you tend to have comparatively few tangible assets as an IP-rich business. There simply isn't the same need for investment in lots of hard physical things that there used to be a number of years ago. So balance sheet weakness is one issue, but the other one is that because you have to write down expense basically through your profit and loss account, a lot of your intangible investment, which is really for the longer term, it makes your profitability look worse. And also a further complication, although this is reduced since the new rules came in, is that not all accountants are terribly familiar with development capitalization rules and what it's possible to do. Now, I'm not saying that it's necessarily in every business's best interests to slap everything you possibly can on the balance sheet. There are some potential downsides, particularly because you then have to carry that balance sheet charge over a number of years, however long you're writing down the intangible assets over. But increasingly, we find that the majority of businesses do find it advisable to at least think about this and have an informed conversation about how you get more visibility of what these assets really are and the fact that they are assets rather than simply lines of expense. But they cause significant distortions in terms of how businesses are perceived to perform and how strong they appear to be. Now, fortunately, these issues probably matter a little bit less than they used to, because the way that, particularly for technology companies, valuations are thought about has changed a bit. If I talk in very broad terms to start with, leading companies used to generate value by basically controlling and multiplying the means of production. And you can see this most clearly in the post-industrial revolution period. Everything became mechanized. The strongest and biggest and most powerful companies were the ones who could simply produce more goods at lower cost and often at higher quality as well. That is no longer really the case in our economy today, and the leading companies now generate value by controlling and multiplying a different asset, which is basically knowledge in broad terms. And that's really the reason why knowledge assets are now worth more in an exit event than tangible assets are. It's also the reason why I could show you various pieces of industry research that show that there's a preponderance of value in larger quoted companies, which are the easiest ones to analyze, on intangible assets than tangible ones. If we think about that in sort of strict practical terms, the way that companies used to be priced was essentially this, I would say, in my experience of it, and I've been involved prior to Ingot with 5 business sales and disposals and refinancings. People used to look in the Financial Times and work out what the multiple was that was most applicable to their sector, then make an adjustment for the fact that it was a smaller company and simply apply it to a profit number. If I give you a really specific example, I used to be involved as a director with a business called HPI, which is the organization that determines whether a car that you want to buy is written off or stolen, or most importantly, still on finance. Now, HPI had a very interesting journey after it was subject to basically a reverse takeover, which brought it out of the credit reference agency Equifax. That happened in 2000. It was then refinanced in 2003, and it was ultimately bought by what's now Aviva, Norwich Union, in 2004. And during that period of time, its value went from 27 million up to 80 million, up to 120 million, which was very nice, of course. The 120 million figure, I distinctly remember, was essentially derived from a multiple of 12 on EBITDA, which is earnings, as you probably know, before interest, tax, depreciation and amortization. So it's a kind of measure of underlying profitability. And back in 2004, it was probably a bit more reliable than it is now. We did very well to get a multiple of 12. So what does it mean now? Well, why was it bought in the first place is quite instructive. There were various synergies and economies of scale that could be driven out of the data, which is very, very rich and deep data that HPI had on vehicle histories. And in that case, as in most others, there's normally an internal business case on how future profitability, future performance is going to be improved as a result of the acquisition taking place. Not all acquisitions turn out quite like people intend, that's for sure, but there will at least be this business case, and the business cases haven't necessarily changed very much. There's usually still an expectation that either there will be an opportunity to boost sales, or there may be an opportunity to increase profitability through greater business efficiencies. But the basis for thinking about the value that that represents has changed somewhat. And I'll explain why after I've given you a few examples. But the nub of it is really this. If you manage to obtain an exceptional price for your business, by which I mean something that is above and beyond any kind of multiple that you might see in somewhere like the Financial Times on your profits, it will inevitably be something to do with your intangible assets. And that's why managing them, being aware of them and protecting them is such an important thing for organizations to be able to do if you're trying to build up longer term stakeholder value. Okay, sounds wonderful in theory. Yeah, prove it. Well, here's some proof for you, if you like. I do know a couple of the investors who are involved with some of these companies, which have got a little bit of a Cambridge bias on them today, as it happens. And some of them you'll have heard of, and some of them you may not have done. But here are some examples of some concrete IP-rich tech company exits. And the point I want to make to you is none of these businesses, not one of them, had current revenues, let alone profits, where they had any profits at all, that could remotely have justified their purchase price. So they're being bought because of their strategic importance, because in turn of their intangible assets that their teams have created. Let me just flick across a few of them. So SwiftKey, you might recall, is a predictive text pioneering company that ended up being incorporated into lots of Android phones. And Microsoft acquired that in 2016, and they paid $250 million for it. An even bigger number was associated with DeepMind, which was a pioneer in AI, artificial intelligence and neural networks, with a pretty deep set of patents associated with it, as you might expect from the name. They were acquired a bit earlier in Google for the benefits of the analytical capability and the data insights that they could derive from it. And they considered that that was worth $650 million, which was quite a nice payday for someone, I should imagine. But it doesn't all have to be those massive, amazing telephone numbers. If we look, for example, at Newell, the machine-to-machine networks with a number of patents, $25 million paid for that. EV, 26, Nugera, 50. Sometimes these figures are not actually publicly announced, so we're not entirely sure how much Vocal IQ went for. It's virtual assistant technology that Apple bought a number of years ago, because Apple's sometimes quite cagey about these things, but we're fairly confident it was in the range of $50 to $100 million. Cambridge Seymour Sensors, that's never been announced in terms of how much AMS paid for it back in 2016, but we know that it was multiple millions of dollars. And again, this is a kind of price tag which is in no way justified by anything performance related. So what's really going on here? What's happening is that these larger companies are wanting to buy in the innovative capacity, the specific IP, and the teams that are associated with these individual businesses. Now, I mentioned a few moments ago that there's this difference in accounting policies and practices depending on what value IP might have looked like it had in a business that was about to be bought, and what actually gets revealed after a company has bought it. It's worth just taking a moment on those for any of you who are still doubting whether intangibles are really a key driver of business value. So this is what the accountants actually come up with after a business has been acquired. This is based on 2 published reports. I think one of them, the Deloitte one, is getting a bit old, it's been taken down, but the KPMG one you can still find online. So I've just re-baselined these figures so that what they expose is the amount paid for identifiable intangible assets post-acquisition. And the KPMG sample is particularly large, the Deloitte one slightly less so, so probably slightly more reliable figures. Now, I won't go through these in detail, but if you cast your eye down the right-hand column, for example, the thing that will strike you is that around 1/3, as a minimum, across all different sectors, of the value, the price paid for an individual business, subsequently gets allocated to these identifiable intangible assets. So to stress, not goodwill, that's been excluded from this. This is not about the price premium that's been paid for a business. This is absolutely about the kind of assets we want to talk about today. And I'll describe which ones are probably most powerful in a moment or two. But you also see that this value ranges up as high as 50% or more. In fact, there's only really one anomaly in the entire table, which I'll briefly touch on, which is in retail. So general retailers, Deloitte found, about 25% of the acquisition price was specifically to do with intangible assets that were identifiable. In the case of food and drugs, only 5%, which may strike you as a little surprising because obviously food brands in particular are extremely powerful, and so can drug brands be. But what you've got to bear in mind is that this is identifiable intangibles and not necessarily the underlying know-how or technology or, for example, customer databases, which actually are driving the value. Customer databases do get a lot of value paid for them, but may end up being pushed into this goodwill bucket. And that's because when one retail brand buys another, quite often they absorb it and the old brand is no more. So some of the hooks on which you would attach that value may not actually persist through into the new company. But that doesn't mean that value is still not being given for them. If I were to add on the additional unidentifiable intangible value that we can associate with goodwill, then basically you would be up to something like 80% of the total price paid for these businesses. Okay, so I hope that helps to sort of make the point and reassure you that this really is a subject that is worth talking about. And after HPI was acquired, I had the fun of talking to Norwich Union's accountants in order to try and help them understand what they'd paid all the money for. And it was precisely this kind of conversation. So I can attest to the fact that it really does work like this. So let's think about the IP assets. What are going to be of most interest for exit purposes? And the key point, as we've made on all of the previous talks, I think, is that it isn't just about these higher profile intangibles, the registered IP that you have around patents and trademarks and designs. These will be defending your competitive advantage in terms of technology. They will be around protecting your brand value and protecting aspects of appearance and usability that might inherently be scalable. And of course, scalability is one of the big things that every acquirer cares about. It's also all of these other things that fall into the wider intangible bucket. And most of these are identifiable intangibles, but some of them are going to end up being subsumed into goodwill post-acquisition. So to trip very quickly through them, copyright is the default right for protecting platform technologies, software in particular. Contracts will be all of the value producing things like licenses, franchises, the role a business plays within its own supply chain. These are extremely valuable assets. There may be many internal resources like trade secrets and confidential information which simply aren't available in the market anywhere else, and again are inherently scalable. So once the know-how, the secrets, the processes are put in somebody else's hands, they can be used to wider benefit. Then there are all of the relationships that a business develops, particularly the customers and information on the customers, but also the data and the insights into how people use products and services, which again are things that can be multiplied and scaled up to advantage by an acquirer. And lastly, there may even be recommendations. Now, this is the heading that we use for non-unique intangible assets, which are typically available to more than one business, but sometimes very few. So there can be very few businesses in the sector that have specific authorizations or permissions or quality approvals or accreditations to do certain things. And again, acquiring one of those for a large business can be pretty important. So basically, it's all your intangibles that you need to think about, which raises a question: why is it then that companies don't just buy intellectual property? And the answer I would give you on that is there's too much of a risk that this transaction that's just focused around IP is going to end up being a lose-lose rather than a win-win. What do I mean by that? Well, there are some fairly significant disincentives to going down this route for the buyer. The first one is, do they actually know what all of the intangible assets are that they need to control in order to get the benefit of the intellectual property? Second one is, specifically, is the IP actually still going to be usable without the know-how of the team that created it? Quite often the answer is yes, but sometimes the answer is a resounding no. And then the third one is, how on earth can I determine as a buyer what a fair price is for the IP on its own when I've got so few published points of reference? So there are reservations on the buyer's side about simply buying IP, and there are possibly even bigger disincentives for the seller. If you're putting yourself in that kind of position, key question is, if you sell off your IP, will the remaining assets that you have be of interest to anyone else? In other words, if you sell your IP, have you blown your one shot at being able to realize value? Or put a slightly different way, if you sell your IP to another company, will you in fact still have any kind of business left at all? And for an awful lot of companies, the answer to that is no, because the IP is core, it is integral, and without it, you really don't have a business at all. So there are a couple of exceptions which it's important for me to acknowledge. If the seller is distressed, or if the IP is known to be very valuable for enforcement purposes, then individual sales of assets do happen, and on a slightly more frequent basis than you possibly might imagine. But aside from those circumstances, these disincentives prove to be pretty powerful. Okay, so let's move specifically on to valuation, and I want to pick up a couple of examples that I think help you to understand some of the dynamic that may be at work here. So understanding IP value is primarily a good idea in an exit scenario or in planning for an exit scenario, because it really strengthens and underpins the valuation you're placing on the whole business. And actually all three of the basic methods of IP valuation can prove to be relevant in this scenario, but some are probably more desirable to focus on than others. So for those of you who have been on the previous webinars that we've had in this series, you know I'm going to talk about cost, market and income, but I'm just going to focus really on the applicability of each one. So on cost, the reason why you might think about things from this aspect, which is how much would it cost to reproduce my assets or to replace them, is you want to have some kind of a handle on how much of the investment that you've made over time might be either not on your balance sheet or be significantly understated in it. So it requires some degree of analysis of what has disappeared, been effectively flushed through the profit and loss account, rather than ended up anywhere identifiable. The reasons why this is important is that you want to correct any misperceptions regarding the strength and the substance of the business that you've got. And you may sometimes find also that it provides some kind of a useful baseline or backstop for an element of your valuation. Bear in mind, we're not talking about your entire business value, but we are talking about a significant proportion of it. And the earlier stage the company is, the more significant this proportion is probably going to be. The one point to bear in mind, as we've stressed on previous sessions, is that the cost method has a disadvantage, which is it tends to undervalue the power of certain types of intellectual property right to exclude competitors. You can paradoxically end up not really placing very much value on the exclusive monopoly, for example, that you get to be able to exploit a technology if you have it patent protected. But cost is something that we generally do for people in these scenarios if the data is available. The kind of circumstances where it's hard to isolate cost sometimes are if it's been funded in a collaborative environment, so costs have actually been split between a lot of different people, or it's happened in a context like a university where there may actually be lots of areas of investigation going on, and it can be quite hard to try to identify which ones have really led and contributed to the development of a particular solution that's for sale. Moving on, how about market? Well, it's certainly useful, again, for the purposes of having some kind of evaluation baseline or backstop, to do some research into whether businesses that own assets that are a bit like yours have actually been sold. As well as looking for public announcements of deals, which you'll find quite frustratingly often don't reveal the actual price paid because it's in the interest of both parties to keep it confidential. You sometimes find that investment data can give you some useful insights about how much businesses owning assets that are broadly similar to yours have been deemed to be worth by investors. You can't put quite as much trust in it because the investor is unlikely to be buying the entire business, otherwise it would be a sale, but it still provides quite a useful and interesting guide, though as with any other type of market context, it's hard to find assets that are really closely comparable to your own. The whole point of IP, why it drives value and why it's not openly transacted on markets, is that it delivers specific particular benefits. It's not a commodity. So inevitably, you're going to find yourself primarily focusing, I suspect, on income methods. But there's a difference between the income methods in this particular exit scenario, and this is one of the ways in which things have kind of moved on in previous years. Because the motivation for an awful lot of the kind of acquisitions that we've looked at is not that somebody intends to buy the business and simply keep running it on a day-to-day basis. What they want to do is to absorb the technological and innovative capacity of the business and then scale it up. So what you could do with the technology in future is only part of the picture. You can start by thinking about this by saying, well, if I had the same kind of resources that are available to a targeted buyer in the marketplace, what would I be able to sell? What profit would I be able to generate? And you can think about that as being the differentiator that your IP provides. But sometimes it's easier to put it a different way, which is to say, if I can think of a specific named buyer, and there could be somebody in the frame, what could they generate using the assets that I've created? That starts to put things in a really specific context, and that can sometimes be quite helpful, especially if you are fortunate enough to get into a position where the negotiations are going well and everybody seems to be kind of getting along with each other. So cost has some utility. Market is always worth looking at, but ultimately the chances are that the price paid in terms of the proportion of your overall business value that will be down to the IP, because it's always a proportion, it's probably going to be determined using some form of forward-looking, income-oriented assessment. For any still doubting, let's have a quick look at a couple of examples from social media. Now, I'm not saying that these are representative because they're very, very big numbers, but I do think that there are some aspects of these deals that are kind of instructive. And I'm going to start with Instagram, which was bought back in 2012 by Facebook. Now, they paid $1 billion. Nice payday, again, for a company that at the time had 13 employees, had absolutely no revenues at all, but did have 30 million users registered on iPhone alone. Now, the background of this is at the time, Facebook was particularly concerned about competition that they were getting from Twitter. And Twitter had already made Instagram an offer of $500 million, so half the amount that was ultimately paid by Facebook. What is interesting is then what happened after Facebook made its purchase. Within a matter of months, the association between the two had lifted the number of users from 30 million up to 60 million, and by 2019, that number was up to 1 billion users. So massive, incredible, exponential growth as a result of bringing the two businesses together. And interestingly, analysts have recently estimated Instagram's value at being somewhere in the region of $100 billion, which is about 20% of what all of Facebook is worth. And I thought this quote might interest you. We believe Instagram's been able to use Facebook's infrastructure to go more than twice as quickly as it would have on its own. That's something that Mark Zuckerberg said a number of years ago, a couple of years ago, to a group of analysts when he was doing a Facebook results report. So a big number for what appears to be not a lot, but actually an awful lot of competitive advantage has been drawn out of the fact that this platform had already got significant traction. And if you start translating that into intangible assets, it's all about the platform, the data, the customer relationships, the customer interactions, and all of the information and knowledge that can be driven out of that. And maybe in that light, it's not too surprising that then Facebook went on and did another acquisition in 2014 and bought WhatsApp. Now, this time, Facebook paid 19 billion for it, or nearly 22 billion after you take into account all of the share price appreciation that was involved because the transaction was part cash and part shares. This absolutely dwarfed some of the contemporary purchases that you might vaguely recall from people like Google. They bought a company called Nest around the same time for 3.2 billion. Again, around the same time, Apple bought Beats, the headphone business, for $3 billion. Now, again, there was a competitive element to this because Google was bidding around 10 billion for WhatsApp at the time and was keen to get its hands on it. But just to underline the point that I made earlier, in 2013, WhatsApp turned over $10 million. Not so bad until you realize it also lost 138 million. But the thing that it did have was it had 450 million users and was growing its user base at 1 million per day. Also, it had a very high level of engagement. People tended and still tend to use WhatsApp pretty frequently, more frequently than they do Facebook. And WhatsApp now has 1.5 billion users, so it's over half the size of Facebook as an app. So I think the motivation for that's probably pretty clear, isn't it? There is one specific thing that this tells you, which is the importance of introducing an element of competitive tension in any discussions that you're having. We'll come back to that in a moment in the summary. But it's interesting to me that if you go and have a look on that reliable source of data, Wikipedia, it lists 87 acquisitions that have been made by Facebook over the years. The language of the company is that a lot of these are effectively talent hires. In other words, we just want to invest in really good teams. But the point I would make to you is that how do you know it's a really good team? It's a really good team because of the intangibles. The intangibles demonstrate that the talent exists. So they're the proof that the team is good and worth having. Also, I think maybe it's a little disingenuous to suggest that that's always what Facebook does, because it looks to me like sometimes they buy other companies in order to kill them off. But that's probably a story for another day. Okay, so time is marching on. So let me just summarize a few of the key points. And I thought it might be easiest to do these in a series of just do's and don'ts. But I'm actually going to start with the don'ts, if that's all right. The first thing not to do is to assume that a prospective buyer knows or understands a great deal about your IP, or even about IP in general. It's almost inevitable that they're going to need your help to be able to understand the value of what you've got. And that means you need to know it back to front first. Second point is it's not safe to assume that a buyer is as well versed as you are, or now are, in what really drives enterprise value. So it's another reason why this hidden value, if you like, the invisible value that's not on your balance sheet, needs to be the subject of a conversation. If your business is driven by knowledge and intangibles, you're going to have to explain what you are, but also you're going to have to make the connection between the value that your business delivers to you now and is capable of delivering for them in terms of intangibles. Clearly, it's not wise to leave everything to the last minute. Most advisors suggest that you plan for exit at least 12 to 18 months, preferably a couple of years in advance, simply because it takes time to get everything in order. And I suppose the lesson for today is don't neglect your IP protection. And here's a really clear reason for that. You do not want a buyer to chip away at your IP valuation because they start finding holes in the protection that you've got in place. And if you're not sure what state your IP protection is in, then very well worthwhile talking to your Enterprise Europe Network advisor and seeing whether you can take advantage of some of their expertise or maybe even an audit in order to figure that out. On the positive side, do try to get into a detailed conversation about what the market opportunity is that the IP and the intangible assets that you have unlocks. Because it's all about generating that excitement and that clear vision about what's the point of doing this transaction. Try, if you can, to move towards a consensus about how big that opportunity is to either generate revenue or to enhance profitability. Because what you want is to get to a position where everybody agrees what the basic numbers should be. Then you can model the value of the assets. But I do it using a transfer pricing scenario. What I mean by that is if you put the IP and the intangibles into the hands of somebody else, how could they successfully unlock the wider opportunity because of their greater resources, access to market, and so forth? It's always worth seeing whether you can generate some degree of competitive tension. And one way you might consider doing that is, I wonder what would happen if these assets were to fall into the wrong hands. That's wrong from the perspective of a potential acquirer you might be talking to. So the long and short of it is try to put together a well-grounded assessment of IP value that can give substance to your negotiations, not forgetting, obviously, as we've seen, that IP value is not likely to be the whole story. It's just the most exciting part of it. And the earlier stage your business is, the less traction it currently has in the market, the more of an IP story you should be looking to tell, if you possibly can. And to that end, in conclusion, there is, as Andy mentioned earlier, a free IP valuation offer if you qualify. If you go to the EEN and are able to sign up for one of their support packages if you're eligible. These are tools which have been used many hundreds of times to help businesses to raise finance, but also to support exit negotiations. Sometimes the buyer uses them, which is worth knowing. More typically, it's the seller that's seeking to understand what value is hidden and needs to be articulated. So if you're an existing Innovate UK supported business, then I believe you're going to get a call, and if not, you can call EEN. But at that point, I will hand over to Andy. Thanks very much for your time and attention. We've really enjoyed doing these sessions, and I hope there might be one or two questions. We shall see. I'll let Andy take over the slideshow now.
That's great. Thank you very much, Martin. And a very warm virtual applause for that. That's very insightful and very, very interesting. While we wait to see if any questions are coming in, I've got one from myself, which is around, I think you started to touch on it. For me, it was the vanity versus the sanity part of the valuations. And it's this idea that I suspect there's quite a few companies out there, particularly younger companies, that have an idea of their exit strategy, of what they're producing, what it's going to be worth. And then versus when they start to engage is people having a different view. And as you were talking about around that, trying to get a consensus view. Is there any kind of examples, or are you able to expand on that at all as to how you can help companies with that kind of sanity check? I did like the idea of the putting yourself in the other people's shoes and how you scale it.
I think that's how you have to do it, really. It sort of depends a bit on how you construct your business plan, and what the balance is in your business plan and your prospectus, if you like, if you're openly marketing a business for sale, between what I would call top-down approaches and bottom-up approaches. Bottom-up, to me, is where you actually show on a step-by-step credible basis how you can sell to more customers or sell more profitably to the customers that you have. Top-down tends to be the type of business case where you say, well, the market's this big and we think we can obtain X% of market share over Y number of years, and therefore the opportunity ought to be worth this amount of money. The thing about an acquisition scenario is if you're talking to the right people, then actually that top-down view can become an awful lot more achievable and credible. If you're talking to a company that's already got a 10% market share, for example, it's far more credible to be able to think that if you put yourself in their shoes, they really would be able to shift a very significant amount of your product or service. Because it's that whole business of what's the route to market, as I'm sure probably a number of people associated with EEN will be nodding at this point in time. It's the credibility of that route to market that's always the issue for a younger, earlier stage business. You know, once you've got a foothold and you've got some traction and a bit of a track record, then it's far easier for people to be able to see how something can scale if it's got the right resources. But until you really get a strong foothold, it's quite difficult to show that that top-down view of life is really credible.
Brilliant. Thank you very much for that. I can see we've got a question that's come in from Victoria Forrest. And I can see that it looks like Alison would like to answer this one live. If I could hand over to Alison.
Yes, hello everybody. Well, it's probably going to be a team effort, so I might ask Martin to comment as well. But Victoria's very kindly asked that she's got patents pending, and she's wondering if there's any way, first of all, to go through her patent documents and value the IP. So that's question one, and also if she can find applications of patents that I've not thought of yet. So perhaps the first one, in terms of valuing your IP, and Martin might want to also comment as well. Absolutely, even although your patent pending, what happens in a valuation, a bespoke valuation, and this is something that potentially can be done using the IP audit that Andy has mentioned, is actually looking sort of at the quality of the patent and the potential for that patent. So there'll be questions along the lines of what's the expectation to grant, and also you know, how you've gone about the filing strategy. You know, have you only filed for protection in the UK, for example? Do you still have the ability to perhaps, you know, you're within the 12-month period, there's, you know, priority period, and file elsewhere claiming priority from your UK application. So be looking at the quality of the application. Hopefully that will be drafted by a patent attorney. So we can see it's a global PCT, perfect. So it'll be looking at the stage of that prosecution. It'll be looking at things that have come back from, comments back from the examiners, looking at the prior art and the potential to grant. So lots of sort of questions around the quality of that can be taken into account. Also about finding applications, the patents that you've not thought of yet, will absolutely look and use the patent databases. You can get access to these free. One of the main ones is Espasnet. There's others out there. Espasnet is one that's overseen by European Patent Office. And you can utilise those well as part of your business strategy to actually help you to see what's out there in the marketplace and see what your competitors are doing. You can use keywords, you can use patent classification codes. There's all sorts of things that you can do utilising those sort of databases. So that's a little bit of hopefully help. But if you've got any other questions, Victoria, I will keep an eye out for them. I don't know if you want to add
That's
any.
great, thank you very much. Yeah, thank you, Alison. Yeah, also what we'll do is we'll pick up with you after the webinar, Victoria, as well, and we'll make sure that we supply some additional information to you as part of this webinar as well, and go from there. I'd also like to pick up, there was one that came in as well that I think Martin would like to pick up from Paul Upton, which was around, yes, is the barrier. Do you want to take that one, Martin?
Sure, yes, Paul. So you're asking, is the barrier to entry into the market relevant to the IP valuation, for example, in the case of something like the NHS, which is hard to get into? Yes, Paul, it is relevant, but the way that it becomes relevant is effectively how credible the valuation that you produce really is. And that comes back to what we're talking about in terms of traction and in terms in an exit context of putting yourself into the shoes of another company that already has that access. There's one important caveat in terms of what access actually means, I guess, which is that the NHS is a large and very diverse organisation. We've worked with quite a few companies who have sought to gain access to it. I know Alison and my other colleague Ian definitely have. And just because you've got access into one bit of the NHS, it does not follow that you've got access into the right bit. So for example, if you're trying to sell consumables and actually all of your contacts are around acquisition of capital equipment, that isn't going to help you very much. But it's about credibility. Have you got a route into market, or have the people that you're talking to got the right route into market? If they have, then the valuation can be credible and you can think seriously about what sales you can generate. If you haven't, then it is absolutely an issue, yes. It doesn't necessarily change the numbers, but it changes the probability that those numbers are real. And that's something that a valuation report can take into account and would need to.
Yeah, that's great. Thank you very much for that one, Martin. And then there's one here as well. Oh, Martin's going to pick this one up as well from Tristan. Over to you again, please, Martin.
And thanks for this one too, Tristan. So you're saying, is there an inherent market risk of patents which makes the details of your IP public, and therefore how to justify the expense of securing a patent in a fast-moving, growing business? So basically you're saying, are you better off focusing on building a competitive advantage with trade secrets, with confidential IP, which isn't in the public domain? Right, so the way that we normally tackle this particular question with organisations is to ask you this in return, which is it realistically possible to keep the confidential IP secret or not? And the particular context in which this tends to come up is if what you're doing that's distinctive, that's special, that improves scalability, profitability, sales potential, whatever. If this can be reverse engineered, or if this can be discovered by looking at what you do, then trade secrecy is not going to be a credible way forward. Now, much as I love patent attorneys, we're not in the business of filing patents for people, so we don't have a specific axe to grind, if you like, in terms of telling people that they should or shouldn't do this. But for certain types of invention, really patenting is the only sensible way forward if you want to be able to defend what you're doing. It is unfortunately expensive, but it is something also that investors and potential purchasers can see and understand and place some kind of a value on. But there are equally lots of business sectors where patents really aren't relevant at all and either can't be obtained, or even if they can be obtained, won't necessarily be of huge commercial benefit to you. So, for example, software is quite possible to patent, but somewhat more complex and requires more specialist engagement from the right kind of attorney. And the benefits of it are perhaps slightly less certain as well. One last key point, what's your business model for commercialization? If you are saying that one of the things that you want to be able to do is to license your IP to other people and exploit it in that way, then it's far easier to do that if you can base it on registrable IP rights like patents, where everybody can see what's being granted, and it's much easier to negotiate than trying to license a trade secret. The classic problem with licensing trade secrets is you have to disclose them in order for somebody to make an assessment and license them, and then the cat is effectively already out of the bag. So Tristan, I think your EEN advisor will want to have a conversation with you to understand, if they don't already know, more about what your business and your business activity and model is in order to give you some further advice on that. But I would say for some businesses, patenting is still highly desirable, and for others, scarcely relevant at all.